Hi, everyone. Welcome to the sixth session of the Global Finance Conclave, which is going on at the Jindal School of Banking and Finance. This session is about the future of fintech laws and regulation. And I'm so happy that I'm joined by Ms. Aparajita Srivastava, who is a partner at Ikigai, and Ms. Beni, Chugh, who is a research manager at a Future of Finance initiative at Dvara Research. Right off the bat, I'll introduce both of you, but I'm so happy to see three women sitting on a panel on fintech today, which is so rare. And I'm so excited to have this conversation with you guys. But to introduce our audience to the people in this panel, Aparajita is a lawyer by training. She graduated from the Symbiosis Law School in Pune. She has worked in a plethora of some of the top law firms and companies in India. Before joining Ikigai, she's of course now the regulatory partner at Ikigai. She's recognized as an India expert by OneTrust Data Guidance. She advises technology companies on various things, including product design and new business ventures. She's worked on a whole range of things from digital payments to strategies for new products. And we are very excited to have you, Aparajita, especially speaking to us about the regulatory front of this quagmire that we are in. And we also have Ms. Beni Chugh, who is a research manager at the Future of Finance initiative at Dvara Research. Her work focuses on identifying systemic stability and consumer protection concerns in digital finance. She has previously worked with ASSOCHAM, and has a public policy degree from NLS Bangalore and an MA in developmental economics from the South Asian University in New Delhi. Welcome, Beni and Aparajita. I'll start with the questions, and think of these as mostly themes, and feel free to jump in. One of the first points of discussion I thought this panel could have is to situate fintech in India. And by this I mean, what is it that you think makes fintech in India so interesting? Given that we have had demonetization, we have had a rapid pull into digitization, we have the Jandhan, we have fintech being used rapidly by technology companies and the government of India. And there is this sort of very rapid initiation of technology into finance as well in India. So I would wanted both of your perspectives, both legal and from the economic finance side of things. What do you think about this marriage of technology and finance in India?
Thanks so much, Shohini. And I'm so glad that Aparajita will have so much to add to what I say. But I think at the outset, like your introduction said, one distinguishing feature, starkly characteristic of the Indian ecosystem is the government involvement. And I think we were in the vanguard of establishing digital infrastructure in India. It started with the creation of the NPCI on the payment side, and then payments have long been known as the gateway to formal finance. In the traditional analog, non-digital brick-mortar sense, it was always the bank account, which is the gateway to financial inclusion and other versions of finance. And if it had to be digital, then in digital, it's the payment, which is the gateway to formal financial services. So I think definitely the striking feature is the creation of the NPCI and the innovation that followed in terms of the India Stack, the UPI, which basically what it did was it kind of shouldered the weight of bringing in technology and the private investment that it would have needed if this were done privately. So in economics, we talk of market failures in two ways. One is areas where markets wouldn't operate because it's just not viable. And quite often infrastructure tends to kind of fall into that category. So I think what we did was we kind of created a digital infrastructure, and that kind of made it way easier for people to come and play. That's one part of the story, and that's literally the India story, and probably one of the reasons why other countries are seeing catch up is because of this, omnipresent infrastructure. Of course, there are, in hindsight, this could have been done better. There are issues with it. It's not in its perfect form. There's a lot that needs to be done. But if we were to kind of pin the start of the story, it would be the creation of the NPCI and the whole India stack. Now, where the story is right now, if I can just kind of comment on that as well, how different we are in terms of other jurisdictions. So for instance, another jurisdiction which is super advanced in its usage of fintech is of course Kenya, right? And there the whole story is about Safaricom, and it's about M-Pesa and mobile money. In India we don't see that kind of one product that's the that is literally the emblem of fintech. We do see digital infrastructure, which has become synonymous with fintech, which is the UPI and all of that. But we don't see one private provider. And I think the distinguishing feature here is that the regulator has a strong hold, right? And when the regulator has a strong hold, the probability of too many then kind of innovations coming and becoming big overnight is fairly small, and most of it happens under the radar of the regulator. The regulator may keep issuing warnings, for instance, they do for crypto, while not actually taking action. But there's always a keen observation from the regulatory end, and that's also the kind of story in India. And therefore, what we have seen in India is there was a very, to my mind, what it looks like is a very careful attention that was given to the players who could come in, even though they did not kind of come in with regulatory licenses or invitations from the regulator. For instance, payment gateways aggregators were not regulated until like very recently. But there was a very careful attention of where money was going, where data was going. One kind of bias that the Indian regulator, the RBI and others have had is they are definitely more sensitive to the flow of money than they are to the flow of data. So anything where any kind of permutation combination of entities of value chain where money is flowing, that is definitely more tightly regulated, and there is kind of systems in place to make sure that only regulated entities participate in the flow of money. But wherever there is flow of information or flow of data, there I think the regulator has been more kind of exhibited greater forbearance and let unregulated entities come in, and then eventually they figured out the business models, and when that has happened, regulation has come in. So I think these are the three defining features: widespread digital infrastructure, a careful kind of accommodatory stance from the regulator, and yeah, maybe two.
Yes, Aparajita?
Yeah, I echo so much of what Beni said, especially about how a financial sector regulator, right? SEBI, IRDAI, PFRDA, RBI, of course, they are traditionally hardwired, in fact, even by their founding legislation, to regulate when people pay, people save, people invest. So the moment there is a fund flow, your financial sector regulators will start flexing muscle. But a lot of the fintech innovation that we're seeing is actually data-based. A lot of these fintech products are actually data-based. And to answer your question, Shohini, what's the differentiator of the India fintech story, right? I think it's a couple of things. The real sort of left of center fintech products that have come about in the last few years have used data to sort of offer financial products and services which were otherwise unavailable to large parts of the population. I'll give you an example. Someone who does not have access to formal banking channel, is very difficult to underwrite for a loan. It's very difficult to say whether they'll be able to repay the loan, for how much, how much interest rate should the lender charge. It's also unviable for a bank to start lending someone a small sachet-sized loan, which is what they traditionally need to get by a particular month. A bank will want to acquire a lender only if they are above a certain ticket size. Unit economics will just not play out if they are below a certain size. Now, what that does is it leaves out such a large sort of lending, such a large borrowing base. People who don't have access to traditional banking channels of credit, they will then start turning to money lenders who will charge them exorbitant rates, and obviously there are certain unethical practices also that go along with the collection. And it's completely left to that kind of offline money lending process, which isn't obviously optimal. On the other hand, what financial tech products have done is use someone's data. So for instance, if I give access to my phone book or to my SMS history, a technology platform will underwrite me according to my data footprint. Did I pay my gas bill on time? There are so many parameters. Like one of the underwriting parameters that I've heard of is that in my phone book, did I have a first name and a last name? If I just had the first name, I get a few points shaved off in terms of my credit worthiness. If I had first name and last name, did I have more than 500 contacts? All of this kind of data analytics in this data engine keeps getting sharper and sharper to by the financial tech companies to say, will Aparajita repay her loan? If so, in how much can we leverage her? Is she over leveraging herself? Did she download 5 apps and start taking a facility from all of these apps? So the ability not just to underwrite the borrower, but the ability to also collect from the borrower and sort of reduce the non-performing assets, to reduce the NPAs in the system. What it does is it sort of gives access to sachet-sized curated financial products to a large set of the population which cannot afford to access formal banking channels, and nor can the bank afford to acquire them as customers, simply because it doesn't make unit economic sense. So you've got sachet-sized curated financial products at the one end. At the other end, you've also got new kinds of financial products, right? You don't have the traditional collateralized lending product that is going to a borrower. You have flow-based lending, like even for SME merchants. A payments company which is acquired an SME merchants can say, okay, typically this merchant gets invoices cleared on the 28th of the month. So we can perhaps give them a monthly cycle of a loan. The other thing is it'll create new categories of products. So for instance, a buy now, pay later. I know, when the buy now, pay later actually caters more to the upwardly mobile audience, and it's meant to make payments simpler. It's a loan product, but it's meant to make payments simpler. So for instance, if Ola or Zomato considers me as a credit-worthy customer because I've used their app for so many years, I make, say, higher value payments, etc., they'll offer me a short-term credit product, which is packaged as a payments product. And that's, again, only based on my data footprint. It isn't based on the traditional method of pinging a credit bureau, collateralizing the loan, getting a lengthy KYC process done. So I think the fintech revolution has done two things at the opposite ends of the spectrum, right? It's created new financial products which bring people who don't have access to formal banking, to the formal credit process or the formal banking process, into the net. It's also created new financial products which are meant to make payments easier, meant to make the UI UX, the friction of paying or the friction of interacting with products and services easier, which means that businesses can collect payments from users in an easier, frictionless manner. No one wants a payment product. You want payments to be seamless and at the back. So the easier the payment, the more likely it is that the customer goes from wanting to purchase a good or service to actually making the final transaction. Which is why the entire payments ecosystem, right? The PayUs, the Razor Pays, cater to merchants, because merchants say the quicker it is to make the payment and the lower the transaction drop rate, higher the success rate of your transactions, the more likely it is that my customer acquisition cost goes down and my sort of lifetime value of acquiring that customer goes up. So it's kind of two ends of the spectrum where you're seeing fintech products really come about.
That's I think together we sort of summed up the particulars, the characteristics, right? So one, Beni spoke about the digital infrastructure, which is now converted into a digital financial infrastructure. You spoke about, Aparajita, the use of data, which is supporting this sort of entire ecosystem. I'll come to the question of data protection and financial inclusion in a bit. But drawing on what you said, this customization of these financial products and creating or packaging new kinds of products. You'll have an insurance product packaged as a pension product and packaged as something else. I wanted to understand two things. What do you guys think? A, is there a market failure for laws to enter? And of course, we know that there are some consumer protection, data protection laws, but largely this is a motley of products. When we say fintech, we actually don't know right now whether we're talking about algorithmic stock trading or we're talking about pension products. A, do you think laws are required? And B, which is, I think, a more challenging question, particularly for lawyers to answer, where do you think the role of law ends and something else begins? So, just to give an example, when you look at the whole Jandhan, this direct cash benefit program, everything UPI, relying on UPI and bank accounts, we know that this can't solve for, say, gender problems in finance, can't have financial inclusion of, say, certain caste groups. So, how much can laws do? And where do you think laws can help, and where does the role of law and regulation end and something else come up? I'll start. We are going to follow what Beni suggested. Maybe we'll go with Aparajita first this time, and then go to Beni.
Sure. Okay, so it's such a large question. I'll try to break it down from general to specific, right? In general, and you're absolutely correct. Financial tech is such an amorphous word, right? What does that even mean? Financial tech is almost like saying tech. It's a big, broad umbrella word. But in terms of regulating this space or regulating any kind of tech product, there are two things, right? One is that regulation ordinarily, world over, will follow innovation. It is usually not the other way around. UPI was actually an outlier where regulation came about, enabling regulation came about, and then the product sort of really blossomed in the Indian ecosystem. But usually it's that, you have players which know that there is a patchwork of laws applicable to them, say neo-banking. There's a patchwork of laws applicable to neobanks, but there isn't neo-banking regulations, right? So there's a toe in the water approach by entrepreneurs in this ecosystem. There's some kind of innovation that goes on in terms of, or a little bit of flying blind and flying in the gray of what the regulation is. Now, it's really, really important for the regulator to do two things. If there is sort of heavy-handed regulation to begin with, what happens is that entrepreneurs won't be able to seek investments. Investors will say, look, this is too regulated, or there's too much regulatory uncertainty. You're getting show cause notices from your financial sector regulators. I'm backing off, which has actually happened in many financial tech products. On the other hand, there are two kinds of ways to beta test a financial tech product, right? One is that you have regulatory sandboxes. They have their own challenges, confidentiality, no legal protection, etc., but it is a simulation of a real world environment. The other is that regulators often tweak regulation over time according to the impact of a product in the market. So it is difficult for even a regulator to anticipate that when a financial tech product is launched, what will be the repercussions on consumer protection, on data usage, on monopolistic tendencies. It's anyone's guess, really. It's only when the product scales a little bit in the market that you start seeing edge cases. So for a regulator to come up with regulation that actually, straddles the line between consumer protection and market protection, and also lets innovators sort of do their thing, it takes a little bit of time for the product to scale, for a couple of competitors to come in and actually test the product out into the market. The third thing I would say in terms of project managers, whatever it may be, but if something goes wrong, if you over outsource a certain function, if, for instance, you're a bank that wants to lend and you outsource the core activity of taking the credit decision to a technology partner, I'll come to you. As a regulator, I'll come to you. I'll send you a show cause notice. I'll catch you by the neck. You can then contractually pass on these obligations to your technology partner. So, for example, a digital lending platform will enter into a partnership with a bank, with an NBFC, on whose books the lending happens. It will gather all the data points about Aparajita, and these could really be in the hundreds. It will then use its data analytics engine and say Aparajita lives in this pin code. She's of this gender. She this is her This is her credit history, say according to her credit card statement. It will curate all of this kind of data points and then say, and then give this information to the lender to make the ultimate credit decision. So that's a form of dual regulation, where the regulator, the financial sector regulator, is regulating a bank, an NBFC, a wallet issuer, a payment aggregator. And these entities then enter into sort of contractual arrangements or partnerships with the tech ecosystem. Then the tech ecosystem does sort of the ancillary, traditionally what was thought of to be the ancillary functions, right? They do what they're good at. They develop the apps, they do the customer acquisition, they create slick UI UX, they create a beautiful frictionless journey. But they don't get directly regulated by RBI, by IRDAI, by SEBI. Because the moment there is direct regulation, then there isn't a buffer in between of a regulated bank or an NBFC or a wallet issuer. That kind of direct exposure reduces the sort of ability for a technology company to innovate, to be nimble, to take greater risks, etc. And that's also a really interesting dynamic, right? The relationship between regulated entities and their technology partners. Sort of sum it up, I mean, just two things, right? The regulator needs to, ordinarily, I think the regulator needs to let financial products and services scale just a little bit, just create proof of concept in the market before it comes up with regulations. And then it needs to keep iterating those regulations over time, which is actually exactly what, say, RBI did in the wallet space. And the second I would say is that form of indirect regulation, where there is for a technology company to enter into the financial tech space, there is a soft landing. There is a bank or an NBFC in between, and not direct sort of regulatory exposure from the regulator.
Yeah, wonderful. So what you're really saying is like build some foresight and then come in. Beni?
Yeah, I think I broadly agree with Aparajita. If I had to continue with her framing of direct and indirect regulation, then I think indirect regulation, I mean, all financial products at some point were new, right? So just like fintech being new is not the first case or not the only case. I think the principles of regulation are pretty sound and pretty well established, and those are consumer protection, systemic stability, right? I mean, that's literally, of course, for certain central banks, the whole idea of monetary policy is also kind of combined in their mandate. But if I were to literally look at just the financial products ecosystem, then there are only two mandates, which is consumer protection and systemic stability. I think one thing that we can do better is we have kind of a, bespoke consumer protection framework for almost every product, right? So if you are a P2P platform, these are the consumer protection guidelines. If you are a microfinance borrower, these are the consumer protection guidelines, which is okay. But I think there is a need to take a step back and see that all of these different disparate pieces, analog, digital, etc., have some common kind of, overlaps. And I think that should just be said, that anybody who's in the business of financial products should not cause XYZ harm, should not behave in XYZ manner, should not harass, like some conduct guidelines which are universal and are common, because there are obviously some elements, no matter the medium through which you're providing the product, there are some elements of consumer interface that remain common to all formats. And I think it's high time that we came up with a common understanding of what is good consumer behavior, and say that no matter which guideline, I mean, that's over and above, but the minimum base treatment that you have to provide to your customer is this. I think that kind of just clears out the air on, do we need to specialize fintech? Do we need to provide special guidelines to it, etc.? Because at the base guidelines appear to everybody, and then as cases appear, maybe in fintech you need additional data protection, maybe in fintech you need additional things, and then you just kind of build up on what you have as the base threshold. So I think that's kind of something that we're missing. One jurisdiction that does it well, for instance, is the US, right? So they have the Equal Credit Opportunities Act. Anybody who's a lender needs to explain why they aren't giving the loan or why they're not in a position to give loan. Now, it doesn't matter if you are a microfinance lender, if you're a corporate lender, or if you're doing it via digital means, it applies to you. In India, unfortunately, we don't have this kind of an overarching framework, and therefore what happens is not clear I can assure you that consumer protection framework differs from P2P lending to lending from an NBFC to lending from a bank. But the consumer is not aware where I will be most protected. To them, they are all substitutes that are providing credit. Now, this is what happens when we regulate by entity and not by activity. So I think just having like a universal, comprehensive consumer protection framework that overlays all kinds of products is definitely need of the hour, and more so because there are just going to be so many entities that are now part of the value chain, and even more to come, right? So it should just be clear that whenever you are interfacing with the consumer, consumer protection conduct applies on you. And this is the consumer protection conduct. And let the market actually internalize that framework and compete on the basis of that, right? I mean, now what is happening is that in hindsight, or after a couple of years of, let's say, playing in the field, when you say that, this level of grievance redress is compulsory, the market pushes back because it's in addition to their cost. And there's another side to it, that in most cases the prices are also very tightly regulated, so they have a price ceiling. They can't do much about the final price, and they have to accommodate one more feature of consumer protection within that schematic of prices, and therefore it becomes unviable for them, and it's not fair on them to kind of have an expenditure being put on them after like 5 years of being in business. So all of those are valid points. So why not just at the very start of business say that, these are non-negotiables, this is how you're going to deal with, so please design your business models accordingly. So that's kind of one thing. Generally the principle has been to regulate the activity over the entity. I just want to kind of use this platform to sound one kind of emerging exception that we're seeing to this. In recent speeches from the RBI and also the Bank for International Settlements, what we've heard is in some cases, it seems that entity-based kind of regulation may be more warranted than activity-based. And what I mean by that is, with the kind of entrance of big tech in financial services, what is happening is there are network effects and dominance that these big techs bring. And this dominance is not necessarily in the financial market, it's in an adjoining market, it's an adjacency, but they bring it on to the financial market. And then the fear is that they might become too big too soon, right? And that then causes a systemic stability harm. So there has been a call which is going around in that circuit, in that policy circuit, to say that the systemically important criteria that you use to kind of regulate systemically important entities in banking, which was actually an aftermath of the recession that we just saw a couple of years back, that needs to be relooked and reimagined to say that, does it counter for harms that big tech can create in finance? We can come to those in more detail when we do the data protection segment, but that's one thing on what regulation can do. There are some, and I think just an extension of all of this is there's all this amazing kind of data points that Aparajita has told us about, creation of new products. In fact, I'm happy to report that some of our known providers are serving as much as, this is pre-pandemic, but as much as 33% of their portfolio is new to banking. This is tremendous. This is unheard of, right? And even if we go by the very latest figures of October, I think tons of MSME lending and retail lending is now moving to digital lending. So of course there is some power there to kind of cater to people who were previously being left out. And maybe that's powered by data, maybe that's powered by agility. It's a combination of all of that. So that needs to be preserved. What also needs to be done simultaneously is that there needs to be kind of, data has the ability to change the rules of the game a little bit, right? So it would be great for us to see companies competing on two elements. One is definitely the interest rate. So for people who actually were bank consumers, when they go to digital lenders, there is some emerging evidence to say that they enjoy lower interest rates. So that's definitely a better deal for them. So digital lenders are able to serve them better. And obviously those who were being excluded are now being included by digital lenders. So both of them are great news. The third thing that we want to see, and we are not seeing in the sector, especially as consumer advocates, is kind of a whole financial well-being point of view baked into products, right? I mean, we have Aparajita gave us a very interesting data point of full name versus half name in your phone directory. There are so many ways in which people are gleaning ability to ability to pay, credit worthiness, so on and so forth. They can do a lot more, which is to say that if this loan were given to this person, what would their financial position be, right? We are today at a juncture where we're able to kind of predict the level of distress that a loan might cause on a family even before giving that loan. And I think that's the need of the hour. That's what we need to get better at. And find ways both. I don't know if the solution, if there is a regulatory hold up there as well. But what we really need to do is make that a strategy for competition, that actually providers now compete on not only is my loan cheaper, not only would you have not got a loan, but actually this loan is good for your financial well-being, right? So I think competing on consumer protection is kind of a long wish that we've had.
And it's a fascinating idea. This idea of financial well-being is not often spoken about, at least in legal regulatory language. Since we have about 10 minutes to wrap this up, I thought I'll combine the last two questions. The question on data, which is really the demarcating factor between fintech of today and fintech that existed, say, in the 60s or 70s. And the question of financial inclusion, the underbanked, right? Now we're sitting in India, and of course the ground reality of this is, because we all work in the sector, this industry is functioning on data, and data primarily of people who are new to the formal finance systems, but also new to the internet ecosystem. So here I have just one question. We have the non-personal data protection committee racing, ahead. You have the PDP bill lying in Parliament. We don't know how this is going to play out. But can data regulation really solve these questions of exclusion, of discrimination, of consumer financial well-being? Do you see data regulation being a part of the story, or being the only fundamental regulation that you have now to drive this change forward? What do you think of data regulation with respect to financial inclusion?
I can go first because Aparajita went first last time. If that's okay.
Go ahead, absolutely.
Yeah. Cool. I think data protection is just one of the tools that are needed and available. What data protection will do mostly is preserve people's privacy. Of course, the preamble says that they want to preserve the trust in the digital economy, but at the very minimum, what it would do is it would tell a sector which is fraught right now what is the best way to approach data, what is doable, what is not doable. And I know from providers, I'm just dispelling this huge myth that providers don't want data protection. They're like, we want it. Can you just clearly spell it out what needs to be done so that we can design our processes per it sooner than later, right? So I think the days of looking at it as an additional cost or something that you want to resist are kind of past us, if they ever existed. But the providers that we've been speaking to actually just have one ask: to have a data protection bill which is clear, which is specific, and which they can design for and rely on for some foreseeable future. So I think stability is a concern. The reason that I don't think data protection is the full part of the puzzle, and there are more pieces, is there are several things you yourself said, right? There are population segments that are new to the internet. Digital literacy is extremely low. Internet connectivity is extremely low. There are all kinds of things. So while you might have the technology to kind of glean off data, you don't have the sociology to really understand the person at the last mile. So I think that's the next challenge that providers need to face and fare, which is to say that you really need to understand that two people who are generating same kind of data, what does that kind mean in their context? In one context, it could be a symbol of, let's say, financial independence, that I'm making digital payments, etc., etc. In the second context, it might just be that this person, it could stand for a very different thing, right? For instance, gender is the classic example that we've been looking at. We know that women use their mobile phones differently. The more rural we get, the more difference in the way women use their mobile phones. They would not use it outside of their homes. They would only use it to call their families, etc., etc. Now, models that are made for more urban, upwardly mobile segments, where the number of phone calls is a good indicator of credit worthiness, fall flat, and they will never be able to cater to this kind of segment. And I'm also overgeneralizing and being reductionist, but the nuances are very deep in how people interface with technology itself. So I think what we need to do next is to get the sociology of it right, to really live in people's context and understand that what does this data mean in that context? Is it actually a predictor of distress, or is it actually a predictor of credit worthiness? And I think that's the next battle to be won, to my mind. And the data protection bill will not solve for it. The data protection bill will tell you that you're not supposed to cause harm, you're not supposed to cause discrimination. But how to do it is actually a more sociological problem, anthropological problem. And that's where the next investment should go.
I'm glad you said that, Beni. Aparajita, maybe I can push you a little bit more to tell me, I mean, I'm sure you broadly agree, but how much do you see the data protection playing a role, and what other laws do we sort of weave into the fintech story?
Sure. I mean, I want to speak about this because there's so much, there's so many opinions out there about data protection and financial tech and how to disrupt financial tech in the abstract. So I want to speak about it in a very specific context. Say, for example, in lending, one of the data points that's used is access to my phone book. And like the example I gave, do I have first name and last name? Do I have more than 500 contacts, etc.? And that's a good predictor that digital lending platforms have through their data analytics capability, figure out that that's a good predictor. That is one predictor to know whether someone is creditworthy or not, right? At the same time, digital lending platforms saw really unethical activity happening because people gave access to their phone books. And I'm sure you would have read about, a few months ago, or I think as recently as, just last month, there were reports about really pernicious activity happening for collection. You'd give access to your phone book. The lender, obviously these are unethical lenders, would literally start calling up people from your phone book and humiliating you. It is against the Fair Practice Code. The RBI does have a Fair Practice Code. It is obviously in violation of the Fair Practice Code, right? But the problem is that at the first step, I've given access to my phone book, and I don't know the purpose for which I've given access to my phone book. I believe I've given access to my phone book for XYZ reason, but essentially I've passed over my phone book without, any idea on what it's going to be used for. And it is being used for pernicious, in a pernicious manner to intimidate, to harass borrowers. What happens is that when a regulator sees these edge cases, and they begin as edge cases, a few bad apples starting to misbehave with borrowers, when a regulator sees that these edge cases are growing, then they start muscling through heavy-handed regulation. Then they start saying, I'm going to license digital lending platforms, I'm going to license P2P, or they may consider, I'm going to license P2P lending platforms. A regulator is a blunt brute force. It is not solving for the 95% which are, say, ethical players. It's solving for the 5% which are causing, distress in the market. And the reason I would say that that ideally will remain as an edge case, especially in the digital lending spaces, digital lending is not a unique product. Every payments company right now wants to monetize its payments business, because payments is a negative unit economics business, right? Very thin margins, highly competitive space. Every payments company right now is going down the digital lending route because at least that's a lucrative kind of product to launch in the market. It's in some form is lending, right? You're seeing e-commerce platforms also tagging loans onto their platforms. So the market will correct players which act in a sort of really, really unethical manner in the long term. But people who want to make a short, quick buck and who have the intention to, sort of disrupt the market in a negative manner, take advantages of regulatory loopholes, not only take advantages of the lack of a data protection law, but take advantage of lack of regulatory capacity. The regulator does not have the capacity to run after every digital lending platform. What they do is they go after a Play Store or an App Store and they tell them that, look, take down these platforms, take down these apps because they are pernicious and because they are unethical. Even for the army of sort of trust and safety officials in an App Store or a Play Store, it is very difficult for them to keep taking down these apps. It's like taking down apps is sort of an everyday activity, but they'll keep changing their names, they'll keep changing their credentials, and keep slipping through the cracks. So yes, while you do need a data protection framework to protect companies that want to launch products which create financial inclusion, which have which bring in to the net borrowers who could not otherwise borrow from financial institutions. You want data regulation to be able to obviously do that as well, give investors certainty. And Beni is absolutely correct. Most tech players want a data protection law. They just want the clarity. They just want, they don't want a moving ball of bill after bill after bill, questions after questions, right? But at the same time, what a data protection law will also hopefully do is weed out at the inception these kind of pernicious players, so that financial sector regulators don't have to come down with heavy-handed regulation in the first place, right? You've got a DPA which is working with financial sector regulators to say these players are not taking informed consent. These players are using phone book for absolutely any reason. They are violating purpose limitation. So that not just the financial sector regulators, but also the data protection authority adds regulatory capacity to weed out players before they scale and before they create mass disruption or sort of mass distress in the market. And you have both working in tandem.
Thank you, Aparajita. I think that point that you made about the signaling of regulatory capacity is something that I personally did not think of. So thank you so much for that. Unfortunately, we are running, you sort of run out of time, and we could definitely, the three of us could have many more, sort of discussions akin to the size of the fintech market. But we're very excited that you came, and I'm very excited to continue this conversation with you on perhaps another day when we have more time. But for the moment, on behalf of all of us, thank you so much for spending your Friday evening with us. And I'm sure, there are many students and many participants who have gained so much today from this crash course on fintech. Thank you so much, Aparajita and Beni.
Pleasure speaking, Shohini. It's been a wonderful session, Beni. I've learned so much from even your perspectives. Mine has been more commercial, but from Beni, I always learn from a more sort of policy and financial inclusion perspective. It's been super fun, Shohini. Thank you for inviting us. And
absolutely. We are at the end of this session. So Vidyut, if you can stop the